Namaskar friends, welcome to the channel JIV and CIV Made Simple. If you are preparing for CTP, that is Certified Treasury Professional examination, and if you are looking to quickly revise the entire module A in just 30 to 40 minutes, you are at the right place, because in this video we are going to revise all the important points as per our module A, which is based on financial market and role of treasury. Every content which I am providing you is as per the syllabus which is prescribed by IABF. And friends, we will not only cover the important point, I will revise you the same concept multiple number of time so that you can remember it for the entire lifetime, for your entire banking career. So please listen to each and every word carefully. Please watch the video till the end and you will be able to memorize all the points in just 60 minutes. So let's get started. First of all, let's quickly understand what treasury management in the simplest way possible. Right now, first of all, treasury management simply means managing money, which means how fund comes in, how they go out, how they are used efficiently. It is mainly seen in government, bank and big companies. Right, the main goal is to make sure that there is enough liquidity, that means enough cash flow for a smooth financial operation. Now friends, the government plays the foundation role in the context of treasury management. So it is responsible for creating currency through printing notes and minting coins, which become the base of all the monetary transaction in the country. Now if we talk about the nationalized bank like SBI, they act like an agent of the government. They handle important functions like collecting government revenue, making payment on the behalf of the government. Now friends, let's come the RBI. RBI is called Reserve Bank of India. They act like a bank to the government, right? They issue currencies, they manage public debt, they regulate credit in the economy. Through this function, RBI ensure overall monetary stability in the country. Now friends, in the corporate world, treasury management focus on maintaining the daily cash flow. It manages inflow, it manages outflow of money to ensure financial stability and a smooth business operation. So here is the quick difference. Treasury management deals with government level cash and credit operation. Fund management on the other hand is about business level finance, how company handle their fund. Now RBI is also responsible for currency operation. It issues notes, it distributes coins, even the small denomination. It manages the currency circulation on behalf of the government. So in short, we can say treasury management is all about managing money wisely, whether at the government level, banking level or business level. And its aim is very simple, to ensure that funds are available, stable and used efficiently. So that is about the treasury management, basics of treasury management. Now friends, we will quickly revise the treasury and finance, right? So these are the easy to grasp point that help you understand how money actually move within the bank, business and the economy. So currency chest operation. So friends, if you are preparing for the CTP examination, obviously you are, and if you are looking for notes, PDF, unit-wise theory, 2000 plus MCQs for practice purpose, as well as the previous year memory boost question, and this type of short notes to help you revise the entire content, you can WhatsApp me on the number shown on the screen, or in the description section of the video you will directly get the course link. You can enroll in the course and start preparation. Now friends, let's continue our discussion regarding the currency chest operation. What I told you, bank keep their extra cash in a special vault that is called currency chest, and this currency chest is maintained by the RBI. So when bank have excess cash, they deposit it here. Whenever bank have excess cash, they deposit the money in the currency chest, and when they need cash, they withdraw from it. So these chests basically help the RBI control money supply in the economy by expanding or contracting the amount of money in circulation. Then comes currency backing and evolution. Earlier money was backed by gold and silver, but now it is supported by the government securities and promissory notes. Over the time, paper currency have replaced metal coins, and smaller coins started being made from base metals like copper, like zinc. Also, the use of credit instruments such as promissory notes helped boost trade and commerce, making transaction much easier. Now, if we talk about the scope of treasury management, so it covers everything related to cash, currency, bank fund, liquid investment like government security or mutual fund. In short, we can say that it's all about managing the flow and investment of the money efficiently. Then we have the core banking, core business operation. So every business run on three main functions. First one is the production. Production means what? Creating goods, creating services. Second is the marketing. Marketing means promoting and selling the products. And finally we have the finance, which means managing the money required for both production as well as marketing. So these are the three main functions of every business: production, marketing and finance. Production means creating goods and service. Marketing means promoting and selling them. Finance means managing the money required for both the operation. Now if you look at the function of the finance, so finance function ensure that there is enough money available for all business activity. Now it looks after the long term fund. What is a long term fund? For example, you take the case of fund needed for project or a business expansion. That is a long term fund. So this finance operation looks after the long term fund. The finance function also involve forecasting the future need and prioritizing expenses so that a daily operation run smoothly without liquidity issues. So see, three functions I told you about finance: ensuring fund and ensuring that there is enough money available for all business activity. Second thing, it looks after the long term fund. Third thing, it also involves forecasting the future need and in prioritizing the expense. Now treasury as a finance, here is the simple difference. A finance manager, he focus on arranging the funds, most likely long term fund, right, like loan or investment for big project. That is the role of finance manager. Whereas a treasury manager, they handle the daily cash flow, making sure that there is enough liquidity to meet the short term needs. That's the difference between a finance manager and a treasury manager. Finance manager focus on the long term fund, while treasury manager focus on the daily cash flow, right? Both are crucial for maintaining the financial stability and performance of an organization. So to summarize, we can say that finance is about arranging the fund, while treasury is about managing them efficiently on a day-to-day basis. I hope you can recognize the difference. Finance is all about arranging the fund. Treasury is all about managing those funds efficiently on day-to-day basis. Together they form the backbone of any organization financial health. Now friends, let's switch our focus to understanding the micro and macro treasury perspective and their objective in super simple terms that are easy to remember for examination. First of all, dual level of treasury. Treasury work at two levels: micro level and macro level. At the macro level, the government and the large business manage overall cash, credit and financial instrument. At the micro level, individual business unit look after their day-to-day fund management, basically ensuring that money keep flowing smoothly for operation. That happened at the micro level. Now if we talk about the macro level operation, so at the macro level, when saving in the economy are less than, see, two things can happen: saving is less than investment, right? So at the macro level, what happened when saving in the economy are less than the investment? The government or the big corporate raise money by issuing securities or promissory note. See what they do, they issue security, they issue promissory note, right, at the macro level when saving is less than investment. On the other hand, when there are surplus saving, which means saving exceeding the investment, right, from where saving can arise? From household or foreign investor saving can come, right? So on the other hand, when saving is larger than the investment, then that money is used to fund those borrowing. Right? See, this is the macro level operation. Two things can happen: either saving can be less than investment. When saving is less than the investment, government or big corporate raise money by issuing security. On the other hand, when they are surplus saving, like from household or foreign investor, the money is used to fund this borrowing. In short, we can say treasury ensure that there is a proper balance and financial stability by managing this inflow and outflow effectively, right? This is called inflow and outflow management. So now at the micro level, that is within the business, funds are used to expand production, to support distribution and to support the consumption activity. Three words are there: expansion of production, supporting distribution and consumption activity. When business earn profit, when business generate revenue, these are paid back to the system in the form of taxes, in the form of loan repayment, right? So that is a micro level. Micro means what? Whenever business earn profit, whenever business generate surpluses, so these are paid back to whom? To the system in the form of tax and loan repayment. The role of a finance manager is to maximize the asset, minimize liability and to increase the profitability. Now let's talk about the need for coordination. Both treasury and the finance function must work in a sync. They must work in a synchronology. Why? Because the finance function focus on the long-term asset management. Again and again I am repeating. See, this is a very, very important thing. Finance function focus on the long-term asset management, long-term asset planning, whereas the treasury function on the other hand looks after the short-term fund flow. When I say short-term fund flow, it means managing liquidity on a daily basis. Together, they aim for economy, efficiency, productivity, the three pillars of a strong financial management. I hope it is crystal clear. Now friends, let's talk about the main objective of the treasury management. To make sure that there are adequate funds for daily operation. To arrange money either from internal source like revenue or external source like loan. To ensure timely availability of fund so that business never stop. To deploy fund in the right amount at the right time for maximum efficiency. And finally, to maintain the financial stability, right? And achieve optimal return by using the fund wisely. So in short, we can say that macro treasury keep the economy stable while micro treasury keep business running smoothly, right? So tell me, if I ask you which economy keep the economy, sorry, which treasury keep the economy stable, answer is macro. And if I ask you that which treasury keep business running smoothly, it is micro. The goal of both is simple: to ensure that there is enough fund, there is enough money at the right time, at the right place for the maximum efficiency and financial stability. Do hit the like button if you think that this video is adding value to your preparation. Now friends, let's welcome back. Now let's talk about now we will understand how efficient treasury operation work. We will focus on fund control, timely availability and profit optimization in a clear and practical way. Now let's talk about the fund control and optimization. Efficient treasury management starts with controlling and optimizing the fund. The main idea is don't keep too much idle cash lying around. Why? Because surplus fund leads to opportunity cost. Yes, if you have surplus fund, opportunity cost will arise, which means that money could have earned profit elsewhere. So, treasurer, they must maintain precise cash tracking. They should always know how much money is coming in, how much money is going out. It's also important to keep a contingency margin. Yes, very, very important to maintain this contingency margin. What is contingency margin? It's like, a small reserve for emergencies or unexpected expense. That is called, contingency margin, like a small reserves, right? For emergency or unexpected expense. And when we say cash, it does not only mean physical currency. Cash does not mean only physical currency. It includes bank balance, it includes liquid security, right? So those are investment that can be quickly converted into cash when required, right? So cash does not mean only physical currency. It includes bank balance also, it includes liquid securities also. Now the next point is timely fund availability. The second goal, see, what you're talking about, again I'm reminding you, we are talking about the treasury flow, treasury operation work, right? So first thing I told you, fund control, right? Fund control. Second point is timely fund availability. Let's discuss it now. How it control. So the second goal is to ensure that funds are available exactly when required, not too early, not too late. There are two main sources of fund. One is the capital receipt, like loan or the money from selling the asset, disinvestment that we call it. So they are predictable. You can predict that. Yes, they are predictable. However, on the other hand, if you talk about the revenue receipt, like income from sale, income from service, they are less predictable. So in terms of predictability, capital receipt are more predictable, right? That's why treasury teams must do rigorous cash flow planning. Rigorous cash flow planning is required to make sure that money comes in on time. They coordinate closely with the finance department. With they means whom? Treasury department. Treasury department coordinate closely with the finance department for capital fund, and marketing department for revenue inflow to mobilize fund effectively. You can see now the close coordination between all this department, right? It is inseparable. Now friends, following a planned schedule for receiving fund, they help maintain a smooth operation, steady inflow of the cash. And remember, both domestic and foreign currency, they are treated equally for fund management. There are no regulatory barrier in this context. The third important function is the fund management and profit optimization. Friends, once funds are available, the next step is deploying them efficiently. This means deciding where the money should go, whether for routine operation, whether for temporary investment, or whether for capital expenditure. When we talk about capital expenditure, it is used for buying long-term asset like machinery or building. So these are the things that are not done every day. And when we talk about revenue expenditure, see, receipt we have already talked about. Now we are talking into the context of expenditure. So when you talk about revenue expenditure, it means it covers regular operational cost like raw material cost, wages, daily expense. Treasury manager must continuously monitor the receipt and maintain a prioritized disbursement schedule, ensuring that payments are made based on urgency and importance. So ultimately, these three things help the organization use its fund smartly and maximize the profit without facing liquidity issue. So to summarize, we can say that, efficient treasury operation are all about using money wisely. Control your fund, make sure that they are available on time, and deploy them in the right place. That's the formula for a smooth operation and stronger profitability. And where to deploy the fund, I just told you, capital expenditure are there, revenue expenditure are there, right? So that is the point. Now friends, let's talk about the Basel III. Yes, we are talking about the Basel III and Treasury compliance. Friends, this Basel III is a very hot topic for CTP examination. They ask question in one form or another. So we will break down the key Basel III norm, capital buffer, transfer pricing, and core treasury term in simple, easy to understand language. First thing is that Basel III was introduced to make the global banking system stronger and more stable after the 2008 financial crisis. So Basel III increased the capital requirement for the bank. As you can see, common equity was raised from 2 to 4.5%. Earlier it was, in Basel II, common equity was just 2%. Rather it was raised to 4.5%. Tier 1 capital went up from 4% to 6%. So this means that bank now need to hold more high liquid, high quality capital to protect themselves from financial shock. Yes, you can see in a common equity they have raised to 4.5%, tier 1 capital they have raised to 6%. Then Basel III also introduced two important buffer, that is called CCB, capital conservation buffer, triple CB, counter cyclic capital buffer. So these help bank absorb unexpected losses and maintain stability during the tough time. Now for treasury manager, this means that they must align their fund management practice with the evolving Basel III requirement to ensure the full compliance. If we talk about the additional Basel III and transfer pricing insight, so counter cyclic capital buffer, or we call it triple CB. So this is an extra capital reserve, right, that banks build up during the good economic time. So the extra capital reserve built by the bank during the good economic time, this is called triple CB. It helps offset the ups and downs of the business cycle, especially when earning fluctuate, right? This triple CB, it helped the bank during the it help offset the ups and downs of the business cycle. The range of this triple CB is decided by the national authority, and it usually lie between 0 to 2.5% of the RWA. 0 to 2.5% of the risk weight asset, right? And yes, it is funded through tier 1 capital, tier 1 equity capital. Please remember it. From where funding of this triple CB is done, it is being funded through the tier 1 equity capital. Now transfer pricing, it means setting the internal transaction price for goods and services exchanged between different branches. In a bank there are different branches, and goods and services are constantly being exchanged between the branches. So what should be the price, right? So we set the internal transaction price, that's called transfer pricing, right? So suppose goods and services are being exchanged between the branches, between the departments, between the subsidiary of the same organization. In that case, the pricing, what should be the internal transaction price, right? That is called transfer pricing. It is used for accounting and taxation purpose, both in domestic and international operation. In the treasury context, this transfer pricing help bank allocate liquidity cost fairly between the departments. Yes, that is how it is used. It help in allocating the liquidity cost fairly between the department, ensuring better performance measurement. Then we have some key concept like ALM, asset liability management. The function, basically this is the function, right, which balances the bank asset and bank liability. So on one side we have asset, other side we have liability. We want to balance both of them. Why we want to balance? Because we want to reduce the risk of mismatch, like when loan repayment and deposit don't align in timing or values. It happens most often, right? Loan repayment as well as the deposit, they don't align, right, in timing, they don't align in value, they don't align in timing. Then ALM is required. We need to balance the bank asset and bank liability, right? Second case, if we have Basel record. What is Basel record? Basel Accord are the global standard for banking regulation developed by the Basel Committee on Banking Supervision, that is called BCBS. Why Basel Accord comes to picture? Because to promote financial soundness across the country. That is why Basel Accord comes to picture. Now you can see the evolution 1 to 2 to 3. So let's see the how Basel framework evolved. Right here, evolution has been shown here. So Basel 1 focus on the minimum capital ratio. Right, Basel 1, the main focus of Basel 1 was the minimum capital ratio. What Basel 2 focused on? Supervisory review and risk assessment. While Basel 3 went further, strengthening the liquidity buffer, strengthening the capital quality, and risk management standard. These are the 3 Basel 1, 2 and 3. Now friends, Basically, let's talk about the CCB, that's called capital conservation buffer. This is a mandatory reserve that bank build up during good times. Yes, bank builds a mandatory reserve during good time. It's act like a cushion, allowing bank to absorb loss and stay strong during financial stress or crisis period. So to summarize the point which we have covered just now, please remember these points. Basel III makes banks safer by demanding higher capital and buffer liquidity. CCB and triple CB, they act like a safety cushion. ALM ensure balance between asset and liability, and transfer pricing help manage internal fund cost effectively. All of these together strengthen both treasury operation and overall financial stability. Now let's talk about the economic sector. So basically economy key, if you look at the key economic sector, so economy driven by government, business and foreign sector. All depend on cash, currency and credit for a smooth operation. Now friends, industries and business, they need financial access, including foreign exchange facility. It is very much essential for production, for import and export. Now, continuous circulation of fund through taxes, saving, investment, loan repayment, that is called, fund flow cycle. It keeps our economic operation active and sustainable. Now friends, long-term fund they are sourced from either equity, which means owner's capital, or debt, which means borrowed capital. Right. So from where we can source the long-term fund? Either we have equity or we have debt. They are required for infrastructure creation and project setup. If you look at the working capital need, so these are the short-term fund which are used for raw material, utilities and wages and day-to-day production cost. What is the role of treasury management? See, it manages the finance at both the macro level and micro level. It ensures steady flow of cash and credit. It aims for liquidity, profitability as well as stability. If you look at the borrowing mechanism, government and business often borrow beyond current mean. Instruments which they use are security, equity, shares, promissory notes, treasury bills. These are the instruments being used, and financed by the household saving and foreign sector surplus. Now friends, let's talk about the corporate treasury and international finance. So friends, household and foreign sector generate surplus fund. Household and foreign sector, they generate surplus fund. When I say surplus fund, it means their income is more than expenditure, right? And these surpluses are channelized to the micro unit. Right, these surpluses are channelized to the micro unit, supporting production, distribution, consumption and growth. Right, now if you look at the holistic corporate operation, so corporate success depends on two things: financial asset plus human resource. It involves both tangible and intangible. When I say tangible, it means like capital, it means like asset, and when I say intangible, it means innovations, efficiency. So this holistic corporate operation, it combines both financial and both tangible and intangible. Right. So I have given you example of tangible and intangible. Tangible means something that you can measure, capital, asset, etc. And one more point is that this holistic corporate operation, it impact forecasting, goal targets, and goal settings and long-term performance. What is the role of treasury manager? He handles daily cash flow, fund allocation, liquidity planning. He or she monitors financial stability of the firm and indirectly support economic balance. And they have a key link between corporate operation and the financial system. If you look at the source of fund, there can be two sources: internal source or external source. Internal can include retained earning, depreciation reserves. These are the things under internal. And if you look at the external, it includes so internal, I have given you example, retained earning and depreciation reserve. External includes capital market like shares and debenture, money markets like corporate paper, commercial paper, certificate of deposit, interbank borrowing under the money market. And it also includes some foreign source like external commercial borrowing, FDI, trade credit. These are under foreign source. So fund structure follow national and sectoral pattern. So just now I have told you the sources of fund. It can be internal, retained earning and depreciation reserve. It can be external, capital market and money market, foreign sources. Now if you look at the international financial market, so they are originated from the global trade expansion and sectoral independence. Modern economy are financially interconnected. No nation is fully self-reliant. The result is that cross-border capital flow is there and international treasury operation is there. How do we do the fund allocation? So fund deployment varies for domestic operation and international operation. If we have domestic operation, then they focus on working capital and short-term needs, and if there are international operation, it includes long-term investment, forex exposure measures, and this multinational company maintains separate plan for current and capital expenditure. Now let's look at the multinational financial flow. Parent companies fund subsidiaries, branches abroad, right? Parent company, they fund subsidiaries and branches which are abroad, and they manage inward remittance like working capital, FDI, trade inflow. They also manage the outward remittance like dividend, royalties, technical services fee. This multinational financial flow is central to global liquidity management and currency risk control, right? Now let's talk about the treasury management scope and goal for global financial integration. So let's understand the scope of it. Global financial market were created to support international trade and finance. That is why global financial market was created to support what? International trade and finance. In today's world, economies and corporates are quite interconnected, right? So that fund move freely across border for business, investment, and trade. So these market help country and company borrow, invest, and manage risk globally. So that is the purpose of the global markets. If you look at the micro and macro interlinkage, you can see that treasury management work at both micro level and macro level. At micro level, treasury management deals with company day-to-day fund flow. But these small level decisions, when added up, they affect the broader economy. It's not that their role is not important. These kinds of small level decision that we take, when added up, they affect the broader economy. Right. And what are the macro level? It includes interest rate, liquidity, overall financial stability. So treasury decision taken by individual firm can impact the national and even global financial system, because they are quite interconnected right now. If you look at the role of the treasury manager, so he is like financial heart of a company, right? So basically they manage cash flow, cash inflow, cash outflow, investment, funding needs. They face competition just like the business unit, but their role ensure that the organization runs smoothly without financial stress. Then we have something called interconnected economic environment. So what it is all about, let's understand. Today corporate world is deeply linked with the domestic and international market. That means a treasury manager must understand not just the Indian finance, but also how global interest rate, how currency value, how capital flow affect their company. Because if there is any changes in the outside economy, it will have surely impact on our Indian economy also. That is why understanding these things is very much crucial. Understanding domestic international system is very much crucial. If you look at the scope level, the scope of treasury management work on three level. At the unit level, it means managing fund within the company, making sure that money is available for operation. At the domestic level, it means coordinating fund with the national financial system, or we call it NFS. And at the international level, it means managing global transaction, right? Currency exposure, cross border funding. So these are the three level of treasury management. Unit level, funding within the company. Domestic level, funding within national financial system. Then we have the unit level responsibilities. At the company level, treasury ensure a smooth flow of fund for all the function: production, marketing, and HR operation. Remember, fund are the lifeline of every organization. Without proper fund flow, even a profitable company can face financial trouble. Friends, using our material, many aspirants have cracked the CTP examination in previously held session. So you can also enroll in the course and get better research result by just enrolling in our course. Now let's talk about the budgeting role. So the treasury plays a key role in budgeting and financial planning. How? Because it helps in preparing and controlling financial, costing, and marketing budget, making sure that resources are used efficiently and that the company maintain a healthy cash balance. So in short, we can say that treasury management connect the company internal fund flow with the national and international financial environment. It ensures liquidity, stability, as well as profitability. Now, friends, we will learn how about the treasury management at the company and domestic level. At the company level, treasury ensure that the money flow efficiently and support all the operation, like budget alignment. So treasury manage financial, marketing, HR budget, and ensure that they match the company performance goal. Then treasury management constantly monitor the money coming in, money going out. During cash shortage, it prioritize urgent payment to keep the operation running smoothly. And treasury work closely with production and the marketing team. It takes feedback from different departments to ensure that funds are used optimally. Then we have the domestic level treasury management. So at the domestic or national level, treasury management ensure that public saving, bank operation are efficiently directed, like saving from the household and business are channeled into profitable investment through the commercial bank. Second point, treasury oversees borrowing, lending, investment activity. Bank also earn revenue from cash and near cash transaction. ALM, I have already told you, asset liability management. So bank align their short and medium term liability with asset, right? based on maturity and cost. Basically ALM ensure that bank stay liquid and financially stable. So in short, company level treasury focus on efficient fund use within the organization, while domestic level treasury ensure public saving and banking operations support on the overall economy. Right. So domestic treasury ensure that public saving and banking operations support the overall economy. Right. Both level are essential for liquidity, stability, and growth. Now friends, we will cover regulatory requirement for bank and government securities management. So bank must follow a strict rule to ensure that financial stability and public trust. So compliance, bank must maintain capital adequacy, provision for NPA, meet the CRR SLR requirement. If you look at the CRR means what? A portion of the deposit it kept with the RBI to control the liquidity. Yes, a portion of the deposit it kept with RBI, that's called CRR, cash reserve ratio. SLR means statutory liquidity ratio. Bank invest in the government security to maintain stability and liquidity. So that is called SLR. Right. Now strategic investment. What is the meaning of it? Sometimes what happen, when the loan demand is very low or interest rate decline, in that case bank can invest beyond a statutory limit. So strategic investment means what? When loan demand is low or interest rate decline, bank can invest beyond a statutory limit. This allow bank to benefit from price appreciation in the government security and earn higher interest. There is something called gilt age market structure. The government security market is called the gilt age market because of its highest safety and stability. So there is primary market where RBI manage the wholesale sales of the government security. Secondary market which called over the counter retail trading among bank, financial institution, right? And finally we have the repo. RBI facilitate repurchase agreement at the market driven rate to maintain the liquidity. Now if you look at the primary market operation, what happened? RBI sell government security to bank. I think we have discussed this. Central government security are underwritten by RBI if subscription falls short, and state government security subscription are facilitated by RBI only. Now secondary market dynamic, I told you that securities are traded over the counter via phone or faxes. Key participants includes DFHI, bank, financial institution, and PFs, pension funds. Then we have yield concept. Yield is the return of investment. Bank loan yield depends on interest payment frequency and market condition. Right. So in short, we can say that bank follow regulatory rules like CRR, SLR to stay safe, invest strategically in government security, participate in the primary and secondary market. RBI plays a central role in managing liquidity, stability as well as the return. Now when you invest in a government security, you can measure return in different way. The first term you have is the nominal yield. Nominal yield is the basic return. How to calculate it? Coupon rate divided by purchase price. That will give you the nominal yield. Coupon rate in the numerator, purchase price in the denominator. That will give you the nominal yield. Real yield means what? It adjusts the nominal need for inflation like CPI, WPI, wholesale price index, consumer price index, showing your true purchasing power. So real yield shows the true purchasing power. Then we have the net yield. Net yield means it takes into account tax deduction, showing the investor take home return. Then we have the current yield. How to go about finding the current yield? Coupon multiplied by face value divided by market price. That is called current yield. Coupon multiplied by face value divided by market price is called current yield. Current yield gives the return at the current market price. Then we have the redemption yield or YTM. The yield you earn if you buy the security at par value and hold until maturity. Then we have the RBI Public Debt Management, PDM. So RBI ensures smooth functioning of the debt market and control liquidity in the banking system. So then we have underwriting. Underwriting, RBI guaranteed unsubscribed government security. OMO, open market operation. RBI buy or sell security to regulate liquidity and interest rate. Then we have CRR and SLR enforcement. They control the cash flow in the bank, ensure financial stability. So CRR is that bank must hold a certain percentage of the NDTL, that is net demand and time liability, as a cash with RBI. That is called cash reserve ratio. SLR means a statutory liquidity ratio, which means bank must maintain a certain percentage of NDTL in cash, gold, approved security, up to 40% of their DTL. Right, that is the rule. So yield help investor understand return from government security, while RBI manage public debt through CRR, SLR, open market operation. Now friends, let's understand financial market and how bank manage their liability and asset. Gilt edge market, already I told you, this market trade the government security which are risk free, highly liquid, offer guaranteed return. Then I told you about the OTC market, a decentralized market for stock, commodities, currencies, trade happen electronically, right? Some rate I have provided you. Repo rate is the, RBI lend money to the bank when they face shortage. That's the rate at which the RBI lend money to the bank is called repo rate. It help control inflation. Reverse repo means RBI borrow from bank. Higher reverse repo rate reduces liquidity in the system. Bank rate means what? Unsecured loan from RBI to bank. RBI give unsecured loan to the bank, which is quite different from repo rate. And OMO means open market operation, which means RBI buy or sell security bills, say treasury bills, right? RBI buy or sell the treasury bill and government security to regulate the money supply. If you look at the bank liability, so bank collect deposits and lend money to generate profit. So their liability are divided into demand liability, which means DL, which are payable on demand, like current deposit, saving, overdue term deposit. Then we have the TL. TL means time liability. So these are the non-demand fund, like fixed deposit, recurring deposit, cumulative deposit. Then we have other demand and time liability. They are miscellaneous, like accrued interest, unpaid dividend, bill payable, participation certificate. Then we have the banking system asset. Bank use their fund to lend or invest in current or other account balance, short-term loan and deposit, which are repayable within 15 days. Other long non-short-term loan in the banking system. This help a bank earn profit while maintaining the liquidity. So to summarize, we can say that financial market provide investment and liquidity channel, while bank manage liability and asset to balance profitability and stability. Let's talk about the global treasury and foreign exchange. We will learn about global treasury management and foreign exchange operation. We have something called international fund management. Global treasury manage fund in multiple currency. It ensure cross-border operation are smooth, whether for trade, investment or payment. If we talk about the currency conversion mechanism, it convert income or wealth from one currency to another. What are the methods used? Direct exchange, check and draft, telegraphic transfer, bill of exchange, trade bill, promissory note. These mechanisms help business settle international transaction efficiently. Right. What about the authorized dealer? Bank and a specialized agency approved by the central bank. They facilitate foreign exchange transaction for individual as well as the company. Authorized dealer ensure regulatory compliance and secure conversion. Then we have the Forex market. The foreign exchange market is the backbone of global finance. They enable currency conversion for international trade, investment and payment. Without a Forex market, cross-border commerce would face many hurdles. So we can conclude that, in short, global treasury manage fund across currency, authorized dealer handle foreign exchange transaction, and the forex market ensure that world economy keep moving smoothly. Now friends, let's switch our focus to how the foreign exchange operation works. So currency demand driver. So demand for foreign currency come from import, export, individual foreign exchanges, and the business trading internationally, they need forex to meet their obligations. Central bank regulate all the kind of forex operation to ensure compliance with the rule. What's the meaning of trade surplus? It means excess foreign currency available. Net importer, they may face currency shortage, right? Scarcity leads to strict foreign regulation, right? Countries with higher trade to GDP ratio, they have more public attention on the forex rule. Globalization make forex transaction a core part of the treasury management. This question may be asked. Forex transaction is a core part of the treasury management, not the dual role transaction. Every transaction involves buying one currency and selling another, right? This every forex transaction involved in one currency we are buying, other currency we are selling, right? And immediate currency release. So for travel and urgent foreign payment we require immediate currency release. Then we have TT, telegraphic transfer, fast, same day, secure with optimal rules. Then we have mail transfer. This is slower, cheaper but delayed payment. But delayed payment may affect interest and rate. What about the financial instrument in forex? You know it very well, that bank draft. So payable order sent to the branches or correspondent bank abroad, that's called bank draft. And paid on site, but transit delay and risk can affect the timing and interest. So to conclude, we can say that foreign exchange operations are driven by trade and individual needs. Central bank regulate the function. Now let's talk about the foreign instrument and market operation. What are the some instrument available? Like the first one we have bill of exchange. It is a written instruction to pay a specific amount. Types of bill can be side bill, which means payment is immediate. Usance bill, which means payment is after a due date or a set period. Categories we have bankers bill and trade bill. Bankers bill are drawn on bank. Trade bill are drawn between individual or business. Please note it down. Right, two categories are there: bankers bill and trade bill. Bankers bill are drawn on bank, trade bill are drawn between the individual or business. If you look at the forex market segment, so the forex market operate at the multiple level. First of all, we have the bank public transaction, interbank trade, overseas branches and correspondent, RBI dealing. So this forex market, most transactions are non-physical. Non-physical means they are done through the credit instrument or digital entry with cash playing the minimal role. If you look at the spot and forward transaction, so spot transaction, what happen? Currency is exchanged immediately. Forward transaction, what happen? That currency exchange is deferred to a future date to align with the payment schedule. Now, what is the importer strategy? They use a spot for immediate payment and they use forward contract to plan for future obligation. If you look at the forward transaction and arbitrage, so forward agreement are the pre-agreed rate for currency exchange in the future. And forward rate influence is that domestic and international interest rate and currency strength are influenced, right? If you look at the risk, see, forward rate may deviate from future spot rate, causing potential financial loss. So to summarize, we can say forex instrument like bill of exchange, spot forward transaction, they help business manage international payment efficiently. You can see the role of forex in the case of treasury. You can see they are the inseparable part. Now, what kind of risk are there? You can see forex risk, which includes credit risk. Credit risk means that the possibility that the foreign borrower may not repay the loan. Then the second risk we have is the currency volatility. Means exchange rate fluctuate constantly. It will obviously create uncertainty. Then we have the country risk. Country risk means what? Political or economic instability in a country. It can increase the loss. Then we have the solvency issue. This means this is like a mismatch between the assets and liability. This can cause default. If you look at the authorized bank in India, so commercial and cooperative bank are authorized to conduct forex transaction. They facilitate international trade financing and a smooth cross-border payment. If you look at the currency management, you know it very well that bank balance current demand and supply, currency demand and supply using their reserves. Yes, bank have reserves and using those reserves, they can balance supply and demand. RBI intervene. How RBI intervene? By buying or selling currency to maintain the market equilibrium. So market equilibrium should be maintained. Supply and demand should be equal. And if they are unequal, then RBI intervene. Either they buy or they sell the currency. If you look at the daily operation, this is called position tracking. So bank maintain daily sheet for each currency, tracking purchase, tracking sale. And unbalanced position are covered to avoid the exchange rate loss. Overbought or oversold position, they are adjusted through currency sale or currency purchase. If you look at the forex dealer structure, major banks supervise branches dealing with forex, right? And dedicated dealing room and back office team handle day-to-day forex operation. So to summarize, we can say that bank face multiple forex risk, but with proper tracking, risk management, RBI support, they ensure a smooth international transaction. Now, dealing room and back office function, very, very important. So we will explore how bank manage forex operation through dealing room and back office. If you look at the dealing room function, first one is the exchange rate negotiation. So it set straight for a large foreign currency transaction. Risk coverage, which means balance purchase and sell to minimize the currency fluctuation risk. Proprietary trading, which means trade currency using the bank owned fund to earn profit. Currency funding, secure fund via swap or dealer purchase. And then we have forward contract management. It handle customer forward contract for future currency need. If you look at the back office function, we have consolidation. You compile all the forex transaction and manage cover operation. Deal analysis, which means assess the deal and predict future exchange rate. Fund transfer, which means one more point is that interbank processing, which means issue or receiving contract notes to confirm the transaction. Fund transfer means they monitors the transfer into the branches or correspondent bank for contract fulfillment. If you look at the GDP, so GDP is the total monetary value of goods and service produced in a country, and this is the key indicator of economic health and growth trend. So to summarize, dealing room manage active trading and risk coverage, back office handle confirmation and fund transfer. Please note it down. Dealing room manage active trade and risk coverage, back office handle the confirmation and fund transfer, and GDP help in understanding the overall economic performance of a country. Then we have financial instrument. Yes, there are some instrument here, like we will simplify some financial instrument like the swap. Swap is an exchange of financial instrument at a pre-agreed future date, right? Exchange of financial instrument at a pre-agreed future date. And so we will break down what is the meaning of corporate finance function and treasury management. So corporate finance, it ensures that company has a strong financial stability, right? And one more point is the investment management, which means they allocate fund strategically to maximize the shareholder value. If we talk about the fund utilization, so we can see that if they avoid any idle fund, they prevent liquidity shortage. We are talking about corporate finance, right? And financing decision. We can raise fund cost effectively and at the right time. Then we have funding strategy. We can balance internal equity, we can balance external borrowing, keeping in mind cost of capital as well as the return. Now, what are the financial and treasury management role? So, finance manager, he align investment and financing with the company capital structure. And fund management, they can source fund strategically to meet the business need. What about solvency focus? Solvency ensure that company can meet the short and long term obligation. Profitability goal is to maintain sustainable profit and adequate return on capital. And treasury operation is to manage the daily cash flow to keep the operation smooth. Treasury role and finance management role, I already told you. Treasury role is to support the finance by efficiently managing operational fund in line with the business objective. So in short, finance focus on strategy and planning while treasury focus on day-to-day cash management. Right. So conclusion is that corporate finance and treasury management work hand in hand. They work together. Finance ensure that company grows strategically and treasury keep the daily operation funded and smooth. That is how they work hand in hand. That is the corporate financing. Now we will explore how finance and treasury function complement each other. I told you now, treasury refine financial strategy and handle day-to-day operation and cross integration. Treasury work closely with manufacturing, marketing, other department to create synergy. And they manage money, forex, government security to optimize the fund. That is called integration of these three things. On one side we have money market, forex market, as government securities. The objective is very simple, right? Financial management objective is to plan capital investment, plan profit budget, plan sale forecast and control the cost. And the objective of the treasury management is to execute this plan by managing the short-term fund. If you look at the finance and treasury responsibility, first point we have fund oversight. Finance raises fund and treasury manage the daily utilization. Who raise fund? Finance raise fund. Who manage the daily utilization? Treasury manage it. Financial reporting means finance prepare profit and loss, balance sheet. They handle taxes, audit and budget. While treasury monitoring, they track the income, they track the expense budget, they perform variance analysis and support internal audit. If you look at the strategic and long-term focus, so finance develop long-term strategy for investment and financing. While success metric, they measure performance by reducing the project break-even time and improving the return. So in short, we can say that finance plan and strategize while treasury execute and monitors. Together they ensure that companies stay profitable, liquid and financially stable. Now treasury and finance strategy. So friends, treasury is for short term. They design the accounting system and control report to manage daily operation. Liquidity management means we ensure smooth cash flow, manage payment and accelerate concern. So we are talking about the roles which is placed by the treasury and finance. So third role is the finance manager, which is for long term. Treasury is for short term, finance manager is things about the long term. They monitor the fixed asset in line with the project duration. Then we have asset upgradation. So review this treasury and finance, they review the asset for depreciation. They decide on upgrade or replacement. Now current asset, if we talk to the context of current asset, so treasury manage net current asset like inventory, receivable and cash. And asset quality, they means we have to maintain SQLA, high quality current asset to ensure strong liquidity. To the context of investment, finance focus on long-term investment. Again and again I'm repeating. Long-term investment finance, short-term investment treasury. Right. Now treasury organization structure. You know it very well that depends on the service range and management centralization. So the treasury organization structure focus on asset liability management. That's called ALM. Then we have ALM role. So ALM role is to manage maturity, interest rate, currency mismatch. And if you talk about the sales and trading, so deals in forex, money market, credit and derivative. Risk management handle back office operation, settlement, accounting and regulatory reporting. So in short, we can say finance manage long-term strategy, treasury ensure daily liquidity and operational efficiency and long-term short-term investment. Together they maintain a stable, profitable, risk managed financial system. Let's talk about the organization flexibility. So there's something called treasury adapt to the company need, from simple liquidity management to full financial service. Look at the treasury organization model. First of all, we have operational flexibility, which means tasks can be outsourced, tasks can be handled in-house based on the strategy. Centralization means, centralized means back office control and supervision. Decentralized means front office decision making near operation. Right, that is called centralization and decentralized. In the case of centralized, we have the back office that is their role placed by centralized. back office control. Decentralized means front office decision. Then we have a unified risk approach, which means that central strategy, local implementation. Full service global model, which means centralized control with unified policies for global operation. Then we have full service local model, independent regional unit cover serving the local need. Limited service global model, which means smaller treasury activity managed directly by the business unit. If you look at the role of treasury manager, cash flow coordination, which means aligning the inflow, aligning the outflow to prevent the fund shortage. Routine but critical. So manager essential daily operation to ensure that solvency and profitability. Accounting system, cross department support, budget override. These are all the role of the treasury manager. So in short, we can say a flexible treasury structure ensure that company adapt to the changing financial need, while treasury manager keep daily operation smooth, cash flow stable, and department coordinated. Some more responsibility they have mentioned like regulatory compliance, right, which means designing system and process that follow legal and tax regulation. Impartial support, which means they manage the expenditure request fairly, that is the role of treasury manager. Crisis leadership and networking. So these are the things. Now integrated treasury, I told you now. So we will discuss integrated treasury. Integrated treasury includes holistic financial strategy, which means managing the bank balance sheet, allocating resource across domestic and international money market. So our aim is to enhance the overall financial efficiency. Optimize asset balancing, asset liability management. It balance our asset and liability. Why? To maximize the return. So there is something called arbitrage opportunity. We identify those arbitrage opportunity to improve the profit. Then we have evolution from the traditional operation. So Forex dealing room, they handle merchant and interbank transaction, and domestic treasury, they manage investment and reserve as independent cost center. Shift to integration. Earlier, they were working in a standalone manner, right? So they are the three part: money market operation. This was separate. Then the our forex operation. This was separate, and the third was our. So all of treasury was working separately, but by driven by there are some factors which cause this unification. What are the factors? Like interest rate deregulation. Then we have recognize relax exchange control, forex market growth, derivative, technology, right? So because of all this, this shift toward integration was there. Okay, forex dealing room were working separately, ALM department working separately. Now expanded treasury role now goes beyond the forex and investment. It includes advanced reserve management, strategic financial function. So we have talked just now that integrated treasury combine traditional and modern practice, optimizing cash, reserves, and investment. If you look at the key treasury function, so first of all, reserve management, which ensure compliance with the CRR and SLR, keep the bank liquid and safe as per the regulatory norms. Second is the portfolio optimization, which means we balance our investment for return maximization. We align our duration, investment duration with the financial goal. First of all, we have a goal. Similarly, we align our investment duration accordingly, and we conduct duration analysis. Why? To manage interest rate risk. Yes, to manage interest rate risk, we conduct duration analysis. Then we have cash flow and liquidity oversight. We track what are the measures inflow, what are the major outflow from ALM activity. And then we build a diversified and a stable funding base. We advise on funding structure, what are the currency mix, loan tenor, cost, expected return. Then we have ALM. So ALM means we decide the ideal size and growth of the balance sheet. That is called balance sheet optimization. We price assets and liabilities strategically while staying with the regulations. Then we have market risk mitigation. So basically what it does, interest rate fluctuation and ALM mismatch. These are managed by it, managed by our integrated treasury. We address the asset risk like disintermediation, securitization, credit derivative. These are the risks which are faced by asset. We monitor the cash flow impact. So what will be the impact on cash flow due to the change in the price of the asset? We monitor that and ensure compliance with the exposure limit. Transfer pricing, I think we have discussed it already, that it balances yield and liquidity to maximize return, right? That is transfer pricing. And we use some insight from funding needs and access to money, capital, forex, credit market. A strategic rate setting, we set the benchmark rate for business unit as well as product. It takes market risk into account to guide effective strategy. We developed some product like IRS. IRS is called, interest rate swap, and cross currency derivative is developed to hedge the exposure. We perform the low risk arbitrage. Now the focus is on to prioritize the high quality asset and to monitor the ROA. What is ROA? Return on asset. It operates like a profit center. Very, very important thing. Treasury operates like a profit center, including proprietary trading. Then it combined Forex and domestic treasury unit. That's called geographical and infrastructural. Horizontal, it aligned trading unit under the unified policy, hierarchy and system. And vertical means centralize the control over trading and arbitrage. Furthermore, we have enhanced financial performance, which means increased portfolio profitability. It combined banking and trading asset, optimized fund utilization, liability sourcing. So in short, we can say, treasury ensure smart fund allocation, risk management, strategic trading, etc. Now friends, we have, in this segment we will explore how Treasury improve our operational efficiency, how it manages risk proactively and structure the operation for maximum profitability. So Treasury enable real-time offline data sharing. It provides a single point of service for the customer. It strengthens our internal control, management information system, regulatory compliance. We have proactive profit and risk management. So this treasury, it acts like a hub for arbitrage and hedging, maximizing return on currency portfolio. And if we talk about the organization structure, so these are the three office: front office, mid office and back office. So front office, what happen? That dealers and trader execute transaction and spot arbitrage opportunity. Mid office monitor, analyze and report risk to the top management. And back office support transaction processing, ensure compliance, conduct audit. Front, dealer and traders. Mid, monitor, analyze and report risk to the top management. And back office support transaction processing. So remember, these are the very, very important thing. Okay, so question may be asked: what are the functions performed by the back office? Please remember, accounting, settlement, reconciliation. These are handled by the back office. They ensure that enough accurate record is there, adherence to procedure is there, and they conduct independent daily review audits, right? Maintain operational integrity. Arbitrage opportunity is always there, which means profit from price difference in different market, right? This is a chance which is present everywhere. Then we have market and arbitrage insight. So in highly efficient market, asset price and exchange rate were well aligned. This reduces the scope for arbitrage opportunity. So if you have a highly efficient market, there is a low scope for arbitrage. And Indian bank uses integrated treasury operation with advanced tools like router, Bloomberg, hotlines, dealing board, etc., etc. So that is all we need to learn from this particular chapter. I request you to please go through the video once, and if you want such kind of PDF, you can WhatsApp me on this particular video in particular number, and I will bring the module B, module C, module D lectures also, so that you can quickly revise the key points.